Hey, colleagues, thank you once again for keeping it with us. And today I want to thank you really for the support and compliments. And as usual, want to discuss accounting content. In the last video, we are talking about the income statement. And now we want to look at the balance sheet for the statement of financial position. Now we are going to first look at the elements of the balance sheet. And of course, one is the assets. The assets, because the balance sheet records assets, equity, and liabilities. So now, assets. What is an asset? We looked at this earlier, and an asset, by definition, is an economic resource controlled by an entity as a result of past events from which an entity expects to generate cash flows, or from which the economic benefits are expected to the entity. So that is an asset. Control means that an entity has the powers to gain from an asset through sale, or it has the capacity to control. So now, if that is the case, I think that is when it is categorized as an asset. Now, when do we recognize an asset? That is a question. When do we recognize an asset in the books of the accounts? One, an asset can be recognized in the balance sheet only if it is probable that the future economic benefits from an entity will flow, from an asset will flow to an entity. If an entity is not expecting any cash flows generated by an asset, then that asset should not be recognized in the balance sheet of the entity. Two, if the cost of the asset can be measured reliably, so if you can really get the cost of an asset, then that asset should be recognized in the books of accounts. But if you cannot ascertain the cost of the asset, then it shouldn't be recognized in the books. Then another condition is that there must be sufficient evidence of existence. If it is a motor vehicle, is it physically there? If it is a software, is it there? If it is not there, therefore, it shouldn't be recognized in the books. Now, we have two categories. We have categories of assets, whereby we have the non-current assets and the current assets. Non-current assets are in most cases referred to as fixed assets, and these are assets that are used by an entity to produce goods and services for more than one accounting period. And when we talk of accounting period, most countries take it as a year, 12 months. So they can be tangible or physical, or they can be intangible. So now tangible items or tangible assets are those that have the physical element. You can touch and see them. For example, we have land, we have buildings, we have motor vehicles, equipments, machines, furniture and fittings, and many others. But also we have the intangible assets. These ones do not possess the physical element. You cannot see them and touch them. Examples, we have goodwill, the purchase of goodwill. 2. Softwares. These assets, the intangible assets, are accounted for using IAS 38, the National Accounting 38, accounting for intangible assets. And the tangible assets, physical assets, they are accounted for using International Accounting Standard 16. I think you look at the previous videos, we looked at that standard at length. So those are non-current assets. So I've said that these are assets that are used by an entity to produce goods and services for more than one accounting period. But also we have current assets. These are assets that are realized, that are to be realized, or they are held for sale, or for trading purposes, and they are expected to be realized within 12 months after the reporting period. So these are current assets. For them, they are expected to be used or to be realized in a period of only 1 year. Going beyond, it ceases to be a current asset. But also, a current asset can be in the form of cash or cash equivalents. So when I say cash and cash equivalents, I mean cash at hand and the cash at the bank. So those are assets. Current assets and non-current assets were explained. Another item of the balance sheet is liabilities. A liability by definition is a present obligation arising from past events, the settlement of which will lead into a cash outflow of economic resources from an entity. So we have a present obligation arising from past events. So a present obligation, there must be a debt, for example. A debt arising from maybe signing a contract. You sign a contract where you have to be paying, maybe it is a reserve rent, where you have to be paying these rentals every year. Those lease rentals every year are a liability because you have to pay them. So the past event was you signing the reserve rent. And the present obligation is that there is a debt to be paid. And now, this settlement will lead into the outflow of economic resources. When you are paying back the lease rental, you need to pay cash, or cash will go out. That is the definition of the liability. But now, when should the liability be recognized in the books of the accounts? One is that should be recognized if it is probable that future economic benefits will be required to settle the liability. If there is a liability, or let's assume debt, and for us to settle the debt, we need cash outflows, or we need cash. Then that liability must be recognized in the financial statements of an entity. 2. That if the amount of the obligation can be measured reliably, that if you are able to ascertain the cost of the obligation or the cost of the liability, then that liability qualifies to be recognized in the books of accounts. 3. If there is also sufficient evidence of existence, if there is evidence that we really have a liability, then that liability must be recognized in the financial statements. Now, we also have two categories of liabilities. Hereby we have the non-current liabilities and the current liabilities. Non-current liabilities, these are present obligations that are to be settled for more than one accounting period. For example, it could be a long-term bank loan, or it could be a debenture, or it could be a director's loan, taking, let's assume, 3 years or 4 years. So that loan, for you to settle it, you need a period that is more than 1 year. So therefore, that one in accounting we call it a non-current liability. But also we have current liabilities, and these are settled in the normal operating cycle. And when we say normal operating cycle, we mean the accounting period of 1 year. 2, sometimes they are held primarily for the purpose of trading. Maybe you could go for a bank overdraft to finance the business. 2, they must be settled within the period of 12 years. So any liability that goes beyond that ceases to be a current liability. So elements of the balance sheet, we have looked at assets. 2, we have looked at liabilities. The third element is equity or capital. Equity is the residue amount after deducting all liabilities from the assets. So if you get all the liabilities minus the total, you less them from the total assets, what you remain with is the equity interest. So in equity, we have items like share capital, we have share premium, we have revaluation reserve, we have retained earnings, and others. Now, let us look at a standard format of the balance sheet before we go into the practical application, or before we look at an example. Now, we have a standard format that was laid out by the IS1, International Accounting Standard 1, preparation and presentation of financial statements. You start with assets, and then report non-current assets first. PPE, intangible assets, goodwill, and then after you can report the right of use asset. Then you can report biological assets in that order. Then after you record, you present the current assets. Inventories, trade receivables, cash and cash equivalents, that is cash at hand and cash at bank. Then the inventory that you report in the balance sheet is the closing inventory, because the title must be saying that the statement of financial position has at. So at the reporting date, what was the inventory? In that case, we report a closing inventory. Then prepaid expenses. Then after you get the total assets, then you follow the list such that you can get it right. You get what? Total assets. Now, total assets must be equal to total equity and liabilities. Now, after getting the total assets, you report now equity and liabilities. As I have told you, you start with capital, the share capital. You report share premium. You report revaluation reserve. Then you report retained earnings, and then you get total equity. Then, of course, after total equity, you report non-current liabilities. In that case, we have long-term borrowing. Deferred tax liabilities of debentures and others depending on what is available or depending on the data that is available. Then, after that, of course, you report current liabilities. You can report trade and other payables. You report short-term borrowings. You can report bank overdrafts. You can report accrued expenses. You can report current tax payable. Then you can report provisions. Then when you total equity and liabilities, this total here must be equal to the total we got. Must be equal to total assets here. Total equity and liabilities must be equal to total equity, to total assets. So let us face it. We are using the same example we used while preparing the income statement. The Rogers Jones, the trial balance is given to us. Property at cost is given to us. Equipment given to us. Purchases, everything is given to us. So let us face it. Let us start. Let us now see how we can solve this challenge. He said that you start with the assets from the template. Then after you report non-current assets. Now from the example here we have property. Report property first. Report property. Now property must be reported its net book value. Property must be reported at its net book value. And how do we get the net book value? So if you did not watch the previous videos about the depreciation, I want to employ you to go and watch that video. You look at all the methods of depreciation and how we arrive at the net book value. But let us look at it in a simple way here. Property, they told us in the additional information that property will be depreciated at 1.5% per annum using straight line method. So I will come here. I will get the cost of property is 120,000, then minus 1.5% times 120,000. What I get is the net book value of the asset. What I get is the net book value of the asset. Now that we are given the accumulated depreciation, because we are not sure when was property acquired, but here we were given the accumulated depreciation, we shouldn't forget this. And the net book value is obtained by getting the cost minus accumulated depreciation. So now we are also going to raise the accumulated depreciation given to us here. For property, it is 20,000. Property 20,000. Then what do we get? 120 minus this becomes 18, 1800, then minus 20,000. I have 98, 200. The net book value for property. Another item is equipment. Now, equipment, the cost for equipment is 80,000. I will come here and I put 80 of the cost. Start. We are raising cumulative depreciation, but here we are told to charge depreciation using reducing the balance. Here, we are using a reducing the balance method. So meaning we are going to charge 25%. We are going to charge it at the what? At the net book value. So now, what was the accumulated depreciation for equipment? It was 38,000. 38. Come here and report minus 38,000. So now, what is the depreciation? So now, let us handle it like this. Let us have it like 80,000 minus 25% times that. What do you get? Let me put the brackets here. Like this, such that we can get it right. So if you can work it out that one, what do we get? Use the calculator. And here I think my calculator is giving me 31,500. So that one is the net book value of equivalent. And those are the non-current assets that we have. Let us now report the current assets. From our question, I saw we have cash at the bank, cash at hand, we have trade receivables, and remember we have inventory. Let us first record this inventory here. The closing inventory is 42,000. Let's record inventory here. Inventory 42,000. 42,000. All amounts are in dollars. 42,000. So you can reduce the fund here. Let us reduce the font to 28 here. I hope you see how we are getting these figures. Then we have receivables. Receivables according to the question. Now how much? Trade receivables. The figure for trade receivables is 38,000. 8,000. Then we have bank. Then we have cash. I've seen that also. Bank and cash. Because the cash is 300 and the bank is 1 3. Cash is 300 and the bank is 1 1,300. Then the cash at hand is 300. 300. Good. Yeah. So that is it. Let us now check properly if you have another item of current assets. Mhm. Current assets don't have. It's like you don't have. So now we are going to total these assets here. And now we get the total assets. Total assets, if we add, I can see get 98200 plus 31500 plus 42,000 plus 38,000 plus 1,300 plus 300 because I have 211 300 211 300. So that is the figure for total assets. So then now let us go to work out liabilities, equity and liabilities. Total assets and that is the figure for total assets. Now let us go to work out the equity and liabilities. Now equity. Mhm. Equity and liabilities. Now let us first record equity. And the equity we have from the question, we have a capital. So is given to us here as 126,600. Figure is here. Shall report capital, share capital. And the 6 plus 126,600. But remember, we have drawings of 24,000. So drawings reduce capital. Then to report drawings here. Drawings here of 24,000. we shall have total equity. Total equity. But before we report total equity, remember, those who were with us, remember we had the profit. Those who followed the session for the income statement using the same question, we have the profit for the year, and the profit for the year goes to the retained earnings. And if you can remember, we got the profit as 42,700. 42,700. So if you total them, if you net off, here you get, use the calculator, 126,600 minus 24,000 minus 42,700. You might have 145,300. That is total equity. Now, we have to look at also liabilities. We have to look at liabilities. Let's get rid of this first. Number. Get rid of this first. How can report liabilities? Let's put in a smaller font. Comments. So for that is also important. So now let us now look at liabilities. We have non-current liabilities. You remember we had a loan, 17% long-term loan. They are even specific that is a long-term loan. 17% long-term loan. How much is it? Is 30,000. 10,000. 10,000. Then that is the only non-current liability. We have current liabilities. And then non-current liabilities, I remember we have trade payables. Trade payables, let us go to the question. Trade payables are here on the credit side, 36,000. So I will come here and I report 36,000. Now, after doing that, I will get total liabilities. So I can add at once. total equity and liabilities. I'm going now to come here. I get total equity as 143. I add 30,000. Then after I add 36,000. This one is 66 plus 145. Here on my calculator I have 211 300. Total equity and liabilities. So now we are going to see, is it balancing? Let us go back and see what we had. Here, total assets 211 300 and total equity and liabilities 211 300. Therefore, the balance sheet is balancing, and therefore we followed all the principles in accordance with IS1. Members, if you find this video useful, make sure you subscribe so that whenever we post a video, you are able to get it or notified by YouTube that we have posted. But also want to thank you for supporting us. We thank you for the compliments and support. Thank you so much. May God bless you.